Well, I actually bought some more Apple the day after Thanksgiving when it fell and the market fell as a whole. And it's up to 16% since then. It's trading at 31 times. Yes, I agree with Jim, so it's not cheap. But this company has earnings, has double-digit growth, right? And they're buying back a ton of stock. Now, I know they've already plowed through almost all of their $90 billion buyback for this year, but they're going to do another one. I think for the next 2, 3, 4 years, they can buy 2 to 3% of their shares outstanding. I like to own a company like that, especially with the moat that they have in terms of products. We know they're very strong and getting stronger. We know services is a nice tailwind and a margin driver. And then finally, we don't know about EV and AR and all that kind of thing, but I'm pretty happy that they're actually getting into those businesses because total addressable market for EV is going to be $1 trillion by the end of the decade. Maybe AR not as big, only $100 billion by 2026. But these are real targeted and strong end markets that you want to be a part of. And again, they have earnings, right? So maybe the stock will stall a bit here, but I feel very confident in the long term. I almost want to own it, put it away, and find other technology companies with strong financials and good end markets. Maybe they're cheaper, maybe they're not, maybe they're in semiconductors. That's where I have a huge overweight. I have enterprise spend recovery companies that are more on the value side. I have a huge overweight there. So maybe complement it with owning something like an Apple.
I noticed, too, that you're doing a little bit of what I asked you about just a moment ago in terms of dips and rips. You sold Fortinet. That's one of your newest moves. Yeah. The shares were up better than 100% in the last year, and you took your profits.
Yeah, I mean, I like cybersecurity very much. It's a very strong total addressable market story. But at 82 times forward and almost 17 times price to sales, I think the easy money has been made, and I think they're doing a great job in terms of product innovation, and on the cost side, they've done a really good job, too, and execution. It's a company that hadn't executed for a long time. That's why I bought it when it was really down, below $100. But I have to say that I think the easy money has been made. I think there's other places to put your money in tech, all of the things that I just mentioned. You can go to Lam, you could go to Broadcom, which, by the way, beat a great quarter. They are increasing their dividend. They increased their buyback. Love that story at 20 times. NXPI is an auto recovery story. They're doing a great job executing. And then we're going to talk about enterprise spend recovery stories, but HPE was upgraded today. I own that. 8 times earnings with a 3 yield. I think that's pretty attractive. And Cisco I've been adding to as well. So I think there's a lot of places. Maybe it's more on the value side, Scott, but you know that's kind of what I look for. Number 1, number 2 in their field and on sale at a good valuation.
You bought Corteva and you bought Target, both worth noting here.
Yeah, look, Air Products I sold. It's trading at 29 times. I've made solid money in that name. Corteva, I just think that there's more upside, 22 times earnings. Ag cycle is really where I want to be for 2022. New management. Dave Anderson, by the way, is the CFO of that company. Remember Honeywell in the Dave Cote years. He was the CFO with Dave Cote as the CEO. He's a remarkable CFO. They have a new CEO. They haven't executed up until this point, and I think this new management team will get them on the right track. Target, I just think quality on sale down 15% from its recent highs on concerns about gross margins. I get it. They missed gross margins by 200 basis points. But I think that was all supply chain, and that's okay because that's eventually going to ease. And I like that it's a quality retailer taking market share in the omnichannel world. I like their mix between discretionary and consumables, more discretionary at about 57% of total revenues. And they just have consistently executed, Scott. So quality company, I'm sorry that I ever sold it. So I wanted to get back on the pullback, back in on the pullback.
Yeah, watching.